Welcome to StockOdds Odds and End podcast for the week starting November 13th. Good evening, Rob. How's everything?
Too bad. So we missed our Saturday. Sorry, too many other obligations, but here we are on a Sunday. Hopefully, we can get this out to everybody soon enough. You doing good, and hope you're doing good. Preparing for a family feast, are you?
Yeah, totally. But this is our last full trading week before Thanksgiving, so people get less serious come the end of this Friday. So,
Well, it is a different week, the week of Thanksgiving. Yeah, it gets kind of mixed because of travel and lower volumes, and then you have your half day on Friday, and so it's definitely a different kettle of fish. Um, okay, so let's move on through this here. I just wanted to review Friday's action because didn't you find Friday a strange day?
it's like the market got amnesia from the day before.
I don't know, something funny went on, like whether they were anticipating the upcoming week, which is kind of been historically a very bullish week. We'll get into that in a minute, but it was almost like Thursday never happened. So I just wanted to review here.
Oddly
We did
risk on.
yeah, we did start the day a little bit elevated here. It tried to dip to test the previous close, and that's always a sign I want people to watch for is it able to fill the gap? And if it's not able to fill the gap, and that should really happen in that first half hour, if not the first full hour, we should see a gap fill. That's what happens historically most often. If it's going to fill the gap, it's going to do it very quickly. And if you don't see that, then you need to get ready for the next phase of indication, which is it able to take out the opening range, like sort of go back through the open price and build on that first sort of 15 minute of range? Is it able to get through that? And if it is, then you're probably moving in that direction. And so that's what we see here. We see some high signal, and then levels off a little bit. We see it again. It keeps staging like that. And literally, just like Thursday, how we closed almost precisely on the low of the day, we almost closed precisely on the high of the day here, right? So complete reversal. So let's look at where the daily is here now. So the last time we talked was after this big move up the week before, which historically has been a very bullish week. And this whole month, is just one where you look at the total breadth of the market. Historically, it's been more robust. It's definitely not a month to get, trying to find things that are going to go down on you. It's better of a month to sort of work with the relative strength and to try to find things that are actually stronger than the market and buy them on pullbacks. That's what November has been historically. And there's been a few upsets historically to that, usually some macro thing, but you got to remember we already pulled back here because of concerns of a lot of different things, and we discussed that last broadcast. But we were able to rally out of that, and then we finished the week right here, and we could have pulled back. We were sitting right on top of the 50-day moving average, and we could have easily pulled back and filled the gap. But the market had an inside day to follow, and it just wouldn't trade into that air pocket. And then it built on that. And then we had the Fed, and we had a bunch of Fed speak all week here too, like we're going to get for next week. So we had a lot of Fed speak. And we just didn't have anything that was significant enough to really drop it other than Thursday. And the market got a little bit spooked, but was able to recover from that and took out the pivot, took out R1, took out R2, took out the high of the day, and continued to build. And so we really have to acknowledge that it's broken, 10-day, 20-day, monthly. I mean, it's breaking. So we have to allow for more upside here on the market. And what's interesting is we're coming into the middle of November, which is historically a good performing week. So that's where we sit. Just wanted to review again here Thursday how we had cyclical and real estate and everything down in the bottom here, everything almost except for energy red for Thursday. And then we flip here to Friday and look at the reversal, everything green, technology on top, and even energy fell in the middle there. But for the week, energy at the bottom still minus 3.32, utilities minus 2.76, real estate. So why you're seeing utilities and real estate here is still this elevated interest rates. Like, we're not in a cycle yet, even if the Fed signaled tiny bit more dovish. We're not in a interest rate cutting cycle. We're still elevated, and interest rates are a real concern to both of these sectors. If you see bonds rallying and yield selling off again, you'll probably see real estate springboard from that. So it's very sensitive to it. And utilities might be okay. I mean, they might be in the middle of the pack or something, probably not right at the bottom. But anytime that the bonds go the wrong way, these guys really end up moving. So keep that in mind. Technology and communication services. So what's in communication? You've got the Meta, Google technology. You've got Apple, Microsoft, semiconductors, all that kind of stuff playing into it. Consumer is cyclical. You've got Amazon and Tesla dominate that. So let's take a look here at the sectors. Diamonds, 0.70 for the week. IWM having a really bad week. The week before, IWM was one of the highest, right? Because it you come into November, it often favors small caps, and that was just a quick little shot that we got for the Russell 2000, and that's all she wrote. I guess it outdid itself. It ran too much, that first week, and so we see it pulling back a little bit. And really, small caps have been, lagging all year. They're actually down for the year, right? So look at this performance right through here. Year to date, down 3% for IWM. Whereas look at the Qs, up 42% year to date. So this trade continues of, large market cap, the most sought after companies in the NASDAQ 100, most sought after companies in the S&P 500, and communications obviously making up a big part of that with Google and Meta. Meta's had an incredible year. So XLK, has Apple as one of the largest in XLK, and the other technology stocks as well in there, Microsoft and so on, all having a good year. So really, this whole landscape has favored sort of the favorites, the best in breed, the most widely traded. I mean, you can go to every broker dealer globally, and you can see that the same names are the most widely traded. And there may be good reason for that. There might be, misplaced sentiment. We don't know, but that's what's been happening. And it's not advised to, bet against, the best in breed and the stuff that's on fire. Just leave it alone until it stops, is what we recommend, or pair it off if you can. But some things are just not that pairable. Like, Dave, what would you pair with Meta if you wanted to hedge it? It's pretty tough. Like any of the Magnificent Seven or the Fangs, we call them too, is like, what are you going to hedge them with? I mean, they're in a class of their own.
Their own special story.
Yeah, they have their own special story, their own special following, widely traded, liquid. And, even when we've seen the market fall and have concerns, we've still seen the mega caps, lead the comeback tour or prop it up or green for the day when everything else is red. So I don't know. It's not smart to to try to be a hero and fade these things. Just let it play out naturally, and and wait until then. So down in the bottom here for the week, XLRE, real estate, utilities, healthcare. XLY was kind of benign. It didn't do that well just because of the mixture between Amazon and Tesla. We'll look at that in a minute. Technology again doing fine. So there's your story. Here's Friday's map of the market, where all the sectors were green. I mean, you still see a little splattering of red. Some stocks like Disney and Corteva and things like that, ANET, they had a bad day, but pretty much everything else was firing well. Semiconductors really had the leadership overall of anything. And here's for the week. And again, semiconductors, Broadcom up 8.48%, NVIDIA up 7.4 for the week, AMD up 5.65. Microsoft, look at Microsoft and Apple to see weeks like that. That's pretty good. Adobe. And then here's your Amazon Tesla story that kind of made the XLY not have amazing performance, kind of held it back a little bit. But completely red there in energy and even in healthcare. See Pfizer slipping, Gilead slipping. So we get into November's mid-month seasonality for ETFs. So looking at this, Dave, now we right away see SMH and SOX. Well, both of those are semiconductor ETFs. We see them at the top of the performance potential for this week, which is full week of it. But they've already run too. So isn't there's a tension there between, it's not like shopping for a discount and then seeing this and go, wow, this is an incredible opportunity. I mean, maybe on Friday they were running ahead of this because this information is actually known. This isn't something that we just come up with. Like, we do our research and we compile this, but we're not the only players that understand this stuff. So maybe Friday was running ahead of this, and maybe it won't run so hot next week. What's your thoughts?
No, it's like potential energy, right? It's like the rubber band thing. So this is already stretched out in the position of where it's supposed to go. So, I mean, probability wise, it's more likely to stay at its level or even retreat a little bit.
Yeah. So, I mean, looking at probabilities, it's likely that the momentum, that strength, begets strength kind of thing, as they say. It's likely that it continues or holds its own. Probably some of the energy potential in that trade is reduced just by the fact that it did run so much the week before. But I still wouldn't be betting against seasonality. We find this, that over the long sample of looking at all of our seasonality data, that it is highly trustworthy, and the only thing that generally interferes with it is some macro type catalyst that comes along and and is stronger in people's minds, and they have to adjust, institutions and everything have to adjust to that new macro. If there isn't one, if it's just sort of like the same old or business as usual, then my money's on seasonality working out for the most part, 80% of the time, that kind of thing. So look at the ETFs that we have in here, basically signaling risk on. IWM down at the bottom, so it's not super strong for small cap still. But we've got real estate in here, interestingly enough, and TLT. So if TLT does rally up, that can cause rates to go down, which can contribute to this XLRE. And the thing is, with XLRE, it did have a down week last week. So that gives me, an opportunity to go, if TLT is behaving itself and interest rates are subsiding a little bit because the bonds are rallying, then I could see going long, XLRE and their components. Semiconductors would have to be really strict if then. Their performance could be amazing, but they've already had a big run. So it'd be more like tread cautiously and make sure that there is follow through there. We see some petroleum, like XLE, the energy very low odds of that performance. And there is like a little bit here from EW Zebra, which is Petrobras. It's a Brazilian ETF. There could be something here to oil bouncing back, but I would definitely play with some of the more obvious and outstanding things. So check each one of these in terms of where they are after last week's move, and then choose wisely. On the short side, we have silver, gold, interesting enough arc, but I mean, again, very low odds, so I wouldn't put much weight on that. Diamonds, which is just basically saying that the market is more risk on and the defensive stuff is going to lag. Communications had a good week, so could pull back a little bit. So that's a little bit of a mixture there of some technology pulling back, whereas mostly risk on. And so 85% of the 102 ETFs in the list, positive by percent change, only 15% negative by percent change. So let's dig into the stocks themselves. So like the semiconductors we're telegraphing, AMD, AMAT, showing you positive expectation. I mean, that's staggering, 7.38% for AMD. So what is it about this time of year? So if we see a pattern, let's ask, what's the fundamental reason why AMD would be so strong historically at this time of year? Let's just say we didn't know about last week's run on AMD at all, okay? And we're just looking at this coming week. What would you say, Dave?
That's tricky. I mean, what's going to spike a chip demand this? I mean, this.
Well, I mean, I would say, gaming, going into the winter season, coming into, Christmas season, things like that, where there could be a lot of purchases that are related to AMD chips. There could be a real demand historically this time of year, more so than, let's say, going into the month of June or something,
Mm-hmm.
So, I mean, I can understand, like, whenever I see that, I always just think, like, what would be the fundamental reason why this would come about historically? And I can't think of anything else except the relationship to gaming, the relationship to Christmas, holidays, just consumer purchases in general, and look at the kind of sales that you get Black Friday and things like that in the tech space. So a lot of, AMD products probably have been sold too. So there's just probably more demand. But I guess nobody listens to streaming music with Spotify this next week.
No Christmas music.
or we don't. Let's see what else. We've got. This is interesting. Charter Communications. So we saw XLC might pull back. So Charter is in XLC, so that could be something. Booking.com, maybe it runs. Maybe the bigger seasonality for it is September, October, and by November, people have already booked their vacations or something. So we do see Nvidia here, but it has a very low probability of going down. But if it was to go down, it could move. So it's playing a little bit different than some of these other chip makers. Not sure why. Maybe some arbitrage there, or maybe AMD just dominates this seasonality so much. So you could keep your eye on that. Let's move to the next screen here. This is now coming to the third Friday. So we have expiration on this week as well. So are there any opposing themes, or is it in keeping? So a little less bullish, but still risk on. There's EW Zebra showing up again, IYR showing up again, IWM showing up again, TLT showing up again. Bark swapped, but it's still only 50% chance there. On the other side, GDX relates to the GLD that we saw and the SLV that we saw previously. Now, looks like a little bit of a pullback on potentially on SMH, but again, the odds of going down are only 37.5. So what you want to see over here is you want to see 62.5 or 75 or 80. That you want to see higher numbers for the probability of going down. So it's still skewed to a risk on Friday. Let's go to the symbols here. You know that I was going to mention something about that trade desk. So the trade desk showed up here, it's showing up again for Friday. But look at what it has here, 100% odds. When I see 100%, I go, well, first of all, check how many samples. So you can mouse over. We can't on the PowerPoint here, but you can mouse over and see how many actual samples. Let me just go to that real quick here and see if I can.
It was down like 16% on Friday.
I know. I was going to bring up the chart. So there's 7 events on the Friday for the Friday one. For the mid-month seasonality on Trade Desk, there is 7 events. So it said every one of those seasons here, Trade Desk has moved up, and its average performance is 7.25. So it's actually incredible. So let's bring the chart up here and look at Trade Desk. So it had that big sell-off, like you said, on Friday. And now, interesting enough, it did recover off the lows. So huge volume on a reversal. So we have a massive gap here. So what the seasonality is saying is that next week, it's actually very bullish for trade desks historically. So if you see this starting to trade into this gap, get above this low and above this high here firmly, there could be some meat on the bone, right? I'm not recommending it. I'm not an advisor. I don't recommend. I'm just saying that you got to qualify it, make sure there's meat on the bone, and that I mean, its ATR is 418 on a $64 stock. That volatility is still there. So percentage wise, you know, this is a mover and a shaker no matter which way you take it. So if it gets legs, if people want to buy this thing, there could be a lot of meat on the bone there. Okay. So that's how we look at things is from perspective of how discounted or how much of a premium as you go into that next window of opportunity. And we do look for gap fills on the daily, but they don't always happen right away. Sometimes they take time. So the third Friday of the month for stocks. So for ETFs, we looked at that. And for stocks, you see some stores in here because we are in retail season. So there's some stores in there. Crocs, Nike. We got some, you know, EV stuff.
Ulta.
You got, yeah. And then on this side, now this is the third, this is expiration. So for some reason, NVIDIA doesn't like expiration that much. So that would be interesting because it's had a pretty big run. Workday, X. So this is a lot more mixed now for the individual stocks because you're seeing some oils come in here. You're seeing some basic materials. So it's a lot more mixed, but it's still skewed to the risk on side, okay? Still slightly skewed that way. So that rounds out your week, okay? Now let's look at where crude oil is here. We had a move all the way down to the 75 number. We broke down below the 200-day MA, and it's sitting underneath there. So it's, you know, it's likely that it could continue to be weaker and go test this consolidation area down into the 70 would be the more realistic mean reversion. So there still could be weakness on crude. At the same time, if it was to get back over the 200, it might, it might rebuild. But we're probably seeing. I don't see it on the streets. I don't see it in the parking lots, right? I see everybody consuming oil all around me. But globally, it could be signaling, more commercial cutback. It could be signaling some demand destruction. It could be signaling recession on the horizon. What's your thoughts, Dave?
This is really weak, especially if you have a Middle East crisis going on and it still can't rally. So, so I think this is not even showing the whole picture, but it's
Right.
even weaker than it appears.
Well, when we look at the seasonality too, it's not saying anything bullish about that really, right? We saw a couple, maybe for Friday, a couple little indications of some oil stocks that might rise, and that could be there. But I think this gives us this 200-day MA to really lean on. And as long as it stays below that, you probably can work this and the group from the short side. You can go into StockOdds and look at which symbols are expected to perform better than others, and that's one way to de-risk is to not like if we're in a chop fest like these kind of consolidation areas can be some of the best for trading. One day up, one day down. Look at this: one day up, one day down, one day up, one day down. Like those can be some of the best, and StockOdds does a pretty good job of that. I think where it can struggle sometimes is when we have a long extended move in the same direction, and you're not getting any mean reversion. You're not getting anything. You're just sort of completely directional. It can be tougher to pick your symbols, especially if it's an upward rally. It's hard to find shorts. But if this gets back into this 70 to 77 chop fest zone, this could be good trading, and especially if you pick your good and bad out of the group. Okay, so that's West Texas crude. Now on the 10-year note, the reason that we got that nice rally in real estate going back a week and a half or so was from this, and then we still had a reasonable couple days while it was elevated, and then real estate pulled back when the 10-year note dropped, because if this is dropping, then yields are rising, and it doesn't like that. So it's hard to say where we go from here. I think it could be just continued volatility back and forth, or it could even slip a little bit further because we've got a lot of Fed speak this week, and I don't know that they're going to be signaling dovishness. We also have inflation data this week. Dave will talk about that in a minute. But all in all, we know one thing is that rates are still expected to stay elevated for longer than the market had originally wanted, right? More than consumers have wanted. And they're going to eventually feel the impact of higher rates on their, spending, their credit cards and everything else. They're going to feel that, right? So maybe they haven't yet. I don't know, but at some point they will. This is the VIX here, and we saw a massive decline after we first had the Middle East crisis rifted up, and last week we talked about that decline as well. And we did expect it to continue to slide as things were in more of a bullish month. This seasonality supports a lower VIX, and we've often seen it drop in November down even into below 15. So we're still have that expectation that it doesn't necessarily need to rally because unless there's, again, a new catalyst, it should just stay where it is or slip a little bit further towards the 14. And it was interesting that, like, you see the pop up on the Thursday, everything was down, and then Friday, the VIX sold off again because we had a really bullish one-day wonder there. Okay, take it away here with economic reports for Monday and Tuesday.
Yeah, in general, there's three themes this week. Again, a weird amount of Fed speak throughout the week. And then we have some inflation data and then some housing data. So Monday, not much. There's a monthly U.S. federal budget report and some Fed speak. But Tuesday is our main report, core CPI. So that's going to give us some more insight into inflation. Again, some Fed speaks mattered in there. On Wednesday, we have the core PPI. So Tuesday gives us more of a sense of consumer prices, and then Wednesday, core PPI, kind of what's happening on the wholesale level. There's also the theme of retail. So there's U.S. retail sales on Wednesday as well. And then Thursday, we have import prices, Fed speak, and a home builder confidence. So that's when we start getting into some housing data. And then on Friday, housing starts, building permits. And again, it's just very odd how much Fed speak there is this week as there was last week. So those are the themes. Housing.
It's incredible. You know, I mean, I'm going to scroll back here. Okay, so Monday we got Fed Governor Lisa Cook, and then Tuesday we've got John Williams and Philip Jefferson, and Fed Vice Chair for Supervision Michael Barr testified to the Senate panel. Chicago Fed President Austin Goolsberg. So moving to the next day here, we've got again more testimony from John Williams, Michael Barr, and Tom Barkin. And Thursday, again, adding Loretta Mester, John Williams again, Christopher Waller, Lisa Cook, Michael Barr again. What are they all going to say the same thing? Are they all going to have different conflicting testimonies and comments? I don't know. Susan Collins, Michael. I mean, it's crazy. So, yeah, it's a big Fed speak week, and I haven't seen it to that degree before. It just pops right out. You like what? Mm-hmm. So we had a lot last week, but even more next week. So what do we have in the earnings area?
Yeah, so this Tuesday we have Home Depot. Again, that shows us how the consumer's doing and what they might be doing in terms of housing. Are they improving their old houses? Are they more likely to buy new houses? And then on Wednesday, we have Cisco Systems. And Thursday, Walmart. Again, retail sales and how the consumer health is. So those are the three major ones for the week, and a couple others that are out there. So check your symbols.
Just wanted to point out SMH, the semiconductor we talked about, and you can see on the daily here the breakout. Now we are penetrating the upper Bollinger Band, so there could be, from a standard deviation perspective, we could be overbought, but you also have to acknowledge that breakout. Let's just take a look at the SOX, and that is bang on here to October's high. So it hasn't busted yet. Let's go to see what the futures are doing since they've been open for an hour and 20 minutes here. Let's take a look at how things are going in that space there. So Dow Jones at the moment, not up, just down slightly. Same with the S&P, down a quarter point. NASDAQ down a quarter point roughly. Russell down a bit more, 0.36. VIX is up 2.69%. So, I mean, we had a big range day on the downside on Friday, so it's just sitting kind of in the middle of that, up slightly. Let's look at our energy here. Down slightly. Let's look at our bonds. Well, let's go to the 10-year here. 10-year down slightly. Looks like it could fall a little bit. Looks like it could fall a bit. Okay, metals. We're looking at gold. I mean, pulled back quite a bit, but I mean, it's still in a pretty stable shelf overall. This whole area from 1850 all the way up to 2050. I mean, that's I just consider that pretty stable, related to the lack of purchasing power on the U.S. dollar. Wouldn't you agree?
Yeah.
The decline of purchase. This is pretty stable, right? Copper. You always want to look at that because it can signal a recession, and it's down off its highs, but it's currently stable. It's not in a free fall or anything. And then, of course, the U.S. dollar is really important to always monitor, and it's just stable here. Not much movement either way. These days, these trading days, like when it's in this kind of chop zone and consolidation, is quite different than when you have it seriously on the move and breaking out to higher highs and higher lows, or vice versa, dropping like this. These are much more significant on basic materials and U.S. Domesticated stocks versus international stocks. When you see moves in the dollar like that, it's really impactful. But when it's just chopping and very small movement, it's pretty benign, its influence. So hopefully that helps you guys. Have a good trading week and fasten your seatbelts. There'll be lots of activity, and we'll see if the seasonality goes as suggested, especially after last week's bullish week too. So we'll see how it plays out. But all the best in trading. Okay.
Good luck.